Thanks for those insights, Gerard. I'm sure there's a lot of benefit for the guys in there. The markets have been topsy-turvy over the last year. I think we really have been impacted by COVID. It's created a huge amount of uncertainty, and I think what it has done is highlighted the need for diversification, not only across asset classes, but across geographies, and possibly more importantly, across the need for diversified fund managers as well. I'm going to welcome Anet today. It's great to have her with us. Anet's going to be talking to us about portfolio manager diversification, portfolio construction, and the impact of cycles on long-term performance. So looking forward to your chat. Over to you, Anet. Thank you.
Good day, everybody. So as you've heard, my topic is the impact of cycles on long-term performance, and somewhat to the theme of what we've spoken to you about before, but today I want to convince you that sometimes if something isn't broken, you still have to think about fixing it. So I'm going to cover today what has worked up to now and why. What are the consequences of those things that have gone well so far for clients? Is there a silver bullet to fixing all of these dilemmas that we're currently facing in terms of investments? A brief reality check on the way we see the world, and then finally, what do we bring to the table? So to start off with, what has worked up to now? I'm going to focus largely on the global sectors and markets, but very much of that also applies to South Africa. So what has worked so far? US equities, particularly large US equities. No one's really wanted to invest in small and mid caps. No one's really wanted to invest in Japan, the UK with Brexit, and emerging markets have certainly been out of favor for quite some time. Index funds, quasi-index funds, very, very popular, and I'm going to speak a bit more about that later. Actively managed funds that look different from the index have not been popular, as we're very painfully aware at PSG Asset Management. The FANG stocks, the tech stocks, have been winners all the way with spectacular returns. But financials, resources, and anything that has to do with the need for economic growth has generally been shunned. If we talk about factors in investments, for those of you who follow those aspects of building a portfolio, growth and momentum have definitely been the winners. Value, looking at free cash flow, looking at dividend yields, that hasn't really mattered. US Treasuries done very well, despite the fact that at some point the interest rates were incredibly low before they started rising recently. And of course, on the other hand, people have been very concerned about SA government bonds, despite the fact that the rate was 7-8% higher than US Treasuries at some point. The US dollar has been very popular and seen as a safe haven, and South African rand and other emerging market currencies seen as very risky. So this is the behavior that we've seen building over the past few years, and some of this has been exacerbated by COVID. Why have these been known? Why are they known as winners? Because they've earned it. They've done really well over the last few years. So if you look at the end of 2020, what US Treasury bonds have done, 10%, and over 10 years, they've even done 5%. That's not bad, given that there's very little inflation in the US. So you've actually done better than inflation. Large cap equities have done between 18 and 15, 14% per annum in dollars over the last 10 years, 5 years, 3 years. The FANG stocks, of course, unbelievable, 45% over 2020, and even over 5 years, 28%. And you'll notice there isn't a 10-year because some of those stocks weren't listed then. The NASDAQ, 49%, it includes a large number of other tech stocks, 28%, 24%, etc. So you can see all of these winners that we are so used to and that worked in the past, they've earned their position of being the winners of the past in the popular areas to invest. I want to then take you to the small caps. I mentioned that earlier. If we then put the small caps in perspective, right up to September last year, over 3 years, they gave you a measly 2%. And of course, what that implies is that a lot of those stocks gave you a lot of negative return over 3 years. Now, 2% per annum over 3 years is very bad. They gave you 10% over 10 years, but that's no comparison to 20% and 14% in the large caps. Roll forward 3 months, and that annual return over 3 years jumps from 2% to 10%. So you can imagine what recovery had to take place in 3 months for that number to reverse. Now, granted, the number in 2020 of 20% is nothing like the FANG stocks in the NASDAQ, but boy, what a recovery. Why have they done so well? First of all, there's always fundamentals behind the success. Sometimes things go to an extreme beyond the fundamentals, but always a fundamental reason. And one of the big reasons is that when you discount future growth, you apply a discount rate. That discount rate is often linked to the long bond rate. And with that long bond rate is very, very low, or even a short-term rate, whatever you choose, that means that the value of that growth in future goes up. And that's one of the reasons we've seen some of the FANG stocks battle recently, because interest rates have started moving up. Of course, the impact of the economic downturn on the cyclical stocks, which are generally found in the mid and small cap parts of the market, has been exacerbated over the last year, making these other stocks even more popular. And then pandemic behavior has, of course, benefited already popular areas. So if you were in real estate, renting space to retailers, and online was already a bit of a threat, imagine what a threat it became when people couldn't go to the shops at all. So some of the behavior during the pandemic just widened those cracks and made these areas a lot more vulnerable. And then, of course, there's also the phenomenon of the more money chasing assets that are going up, the more they go up. And in the 80s, Thaler, who won the Nobel Prize 3 years ago for his work on behavioral economics, back in the 80s, before Reddit, before Robinhood, before index funds were even that popular, he published an article that's still one of his well-quoted articles, which says that if stocks go up, people buy things because they go up, and when they go down, people sell them because they go down. Of course, to a point. So I want to talk a bit about the pandemic behavior. Now, not my proudest moment. I'm personally responsible for killing 2 sourdough starters that were very happy for 200 years before they hit my kitchen. So all of us have done things like baking, and we've done painting, we've renovated our homes. And if we look at the recent South African economic analysis, we've seen that renovating and improving our homes was something that went across all of the income groups. It was a huge phenomenon last year. But that's not the phenomenon that I want to apply to us today. It's the one of online trading. There's only so much Netflix you can watch. So if you've got access to online, you will also trade. So online trading became massive. Why this is important is because it's infused a level of speculation and gearing into the cycle that possibly wouldn't have happened as fast if it wasn't for the pandemic. So this is just in the States. Massive retail participation since March last year, and the focus is on speculative stocks and ETFs. A huge use of derivatives and gearing. So what people did is they sell their unit trusts, which were their long-term investments, and they roll that money over into ETFs and other instruments where they have access to margin accounts. So margin account balances just over 9 months grew by $300 billion in the States. That's the impact of speculation and online trading that has taken place last year. So there's no wonder that those winners just became, their prices just became higher and higher. It's a classic case of fast money in what we call a deviation amplifying market, where the differences become even bigger. You will have heard us speak about those differences, where we stood in front of you and said that this difference is just too big, and it just got worse over the last 2 years. But something is definitely shifting. So this is an unsustainable thing forever, but it can last so long that you can think that it will. So I want to show you something really fascinating. This is an index done by Goldman Sachs. It consists of stocks, startups and tech stocks. They've never made a profit, not 1 cent. And this is the money that's gone into the stock. So it's gone up 3 times, 4 times over 9 months because of speculative interest. We speak a lot about index funds, and it certainly has become a very, very big driver. So what has happened in index funds? You can see by this chart, you can see that net flows, the gray line in the middle, slightly negative. I mean, people have taken money out of the market as they've needed it because a lot of them haven't worked. But you can see the dark blue line, how active funds have lost huge amounts of money. And that means that those stocks that those active managers thought were cheap just became cheaper because they got sold by the people who took their money out of there and put them into ETFs, index funds, whether it's an ETF or a mutual fund, into index funds. You can see the light blue line is shooting up. What are the consequences of all of this behavior? If we look at a normal market where there isn't a high level of speculation, this is the kind of behavior we see. So prices go down, and at some point, so initially you get the behavior of prices go down, people sell it because they're going down, and it reaches some point where people go, I think it's just starting to look a bit cheap now, and they buy it. And the reverse happens, and so the cycle goes. And there's some kind of broad fundamental underpin. Now the market always overshoots on both sides. Stocks become a bit too expensive, they become a bit too cheap. But in this case, you've got more value-conscious orientation, where value-conscious institutions are dominating prices. That's not what we've seen in the last while. You've all heard about Reddit, GameStop, all of those phenomena that have caused prices to go completely crazy. This is what we call a normal market. It's volatile enough for most of us to deal with. What we're dealing with at the moment is a deviation amplifying market. So the fundamental underpin gets forgotten completely. And what happens is as prices go up, you just get more buyers. And if they don't have the money to buy it, they gear up and they buy more, and the prices go up, and people go, oh my word, I've missed out, and they buy more. This is the kind of market we're seeing at the moment, fueled by liquidity and fueled by speculation. I want to just put one caveat out there at the moment. The whole market isn't like that. It's certain segments of the market that have become like that. We've got a hugely bifurcated market at the moment with very different opportunities. So this doesn't mean that the whole market is heading for some kind of issue. So at the extremes in market, you can generally put people into two camps or along the spectrum of two camps. So we've got the guy on the left who worries the whole time. Am I paying too much? Is it going to pay a dividend? What's the cash flow? What's the free cash flow valuation? What's the PE? These stocks are becoming too expensive. He worries the whole time. On the right-hand guy, you've got well-known, I won't say his name, which is about there's a party on and I'm not going to miss out. So obviously over time, you want elements of both in the portfolio, but you never want to be too far on one extreme or the other. You might be right for a while, but eventually those extremes actually work themselves in the middle. Now, most investors are not entirely at one extreme or the other. Perhaps the ones that are buying GameStop are completely to the right. But you either have more of an affinity for the left or the right, or you in the middle and say, listen, I want elements of both. I'm going to construct a portfolio that has all these different elements in. The beauty of that, of course, is that you don't have to make that many decisions because you always have something that's working. So what has happened to prices and yields? Going back to the guy on the left who worries all the time about valuations. Dividend yields are very, very low. And the thing about dividends is they are the most real valuation that a stock can ever show you because it's what's actually being paid out. So interest rates are also very low, with long bonds around 1%, there or thereabouts, expected inflation 2%. And you have to ask yourself, the things that have worked in the past, that have earned the label of being the safe investments, like US Treasuries, like the large caps that are very expensive, like the FANG stocks, are they really still that safe? So if we look at US Treasury yields, they have been this low in the 40s, a little bit higher than this in the 40s, but the last time they were this low is, well, certainly before the chart starts in 1800. And expected inflation I've marked with a solid line. That's not what inflation was throughout that whole period. It's what we expected to go forward. But I'm just going to give you an idea of where that level is. So it's much below inflation. So if you build a portfolio offshore with US Treasuries, it's going to be very hard for you to beat inflation. You're going to have to rely on getting the currency right. If we look at the dividend yield in the S&P, and again here, I want to caution, this is for the broad index as a whole. And as those winners I've spoken about became more and more valuable and trading at higher and higher valuations, they would be driving a large part of this phenomenon. There's still a lot of companies out there with very attractive dividend yields. But those stocks that have become so popular have become bigger and bigger in the index, so they're driving this dividend yield down. So you can see here that the dividend yield isn't always above inflation, but just as an indication, you can find quite a lot of stocks at the moment that will give you just a dividend that's higher than inflation. Why would you want to buy a whole portfolio of stocks that give you much below inflation. On a simple price earnings metrics, and here we've got 66 years of data, you can see there that it is trading at a very high level. So what has happened in our view is there's a layering of risk that's building up on the portfolio. So the safe assets that people have seen in the past, and I'm not saying this audience, I'm talking about general market behavior, which has been the largest stocks dominated by the US, no EM exposure, no cyclical exposure, nothing that's sensitive, economically sensitive. Those assets are now facing 3 layered risks. One of them is they're trading at even more extreme PEs and yields. And I'm very aware that we have pointed this out before, and the cycle persisted for longer than we thought it would. They're dealing with very uncertain future rates. If you've got a very low interest rate of 1% that is built into your discount rate for the future and it moves to 2, I mean, imagine our rates going from 7 to 14. That's the impact. It's going to have a huge impact on valuations. And the third one is these areas are not undiscovered. Everybody's already there. So these are the 3 things that worry us about the so-called safe assets. We've been here before with cycles, and they last forever until they stop. We've seen it in the 80s, where the oil price went ballistic. And look at the top stocks, the top largest companies in market cap in the world. Almost all of them were either oil, okay, apart from AT&T and General Electric and Kodak, oil companies. Then we had the 1990s, late 80s and 90s, where Japan could do no wrong. And we don't need to be reminded how long it took for Japan to even recover to where they were at that point. So all of the large stocks were Japanese stocks. Then we had the first TMT bubble. You could see all the large IT companies. And some of those companies, when bought at the peak, took more than a decade for investors to get their money back. Then we've got China was going to take over the world, and all the big Chinese companies were there. And there's one stock that made 3 cycles, and that's Microsoft. So it made the TMT bubble. It was top 10 even when China was dominating, and it's top 10 now. So the thesis at the moment was that because of people working online, everything moving online, the economy being so poor, and many other reasons, US tech is the only way you're really going to get growth. And people were prepared to pay such a lot for growth. But we've been here before, and all of these cycles have come to an end. Is there a silver bullet? How do you solve the dilemma of figuring out, but Anet, you stood here last year and the year before, and you told us these are extremes, but it didn't end. So what are you suggesting we do? And if we look just back to South African market, a classic example for me here, but how quickly things can shift and why you do have to have a spread of investments, even the ones that you don't like at the moment, is if we look here just at the US dollar, and very important to have international diversification, always important. But look at the turnaround between the dollar over 3 years and over 3 months. From 9%, which meant that the rand depreciated, to flat, at a time where people became increasingly negative on South Africa. Look at the property market. It was the darling 3 years ago. It was a cornerstone of portfolios. Yet over 3 years, right to today, it's given us minus 14% per year. And we know that there are even bigger losers within that sector than a mere 14% decline. Yet in the last 3 months, if you were invested in that sector, or if you had a small allocation, maybe that you bought when the yields were very high, you would have made 20%. The point of this, what we call our rainbow chart always, is just to illustrate how quickly shifts take place and how important it is to recognize that at some point, if you have a well-diversified portfolio, parts of it will make you uncomfortable at points. So I want to move into our alternative view of risk at the moment and what we think is important in building a portfolio. We think it's important that you look ahead to a post-COVID world. We've already seen how quickly shifts can take place, and I'm going to show you in a minute how quickly things can turn around when we start seeing clarity. You can't wait for perfect clarity to know that to know what's going to happen and to make the shift, to take advantage of it. So I think it's very dangerous to base expectations on a simple extrapolation of the past. There was definitely a time last year that we thought this was never going to end. And even now, we're still struggling to get back to any sense of normality. But be cognizant that different market segments are at extremes. And again, I want to use the word bifurcation. There's a huge extreme in the market between different parts. The market isn't one glob that you can just buy. And you would have found this because your clients would have said to you, but the market did this and my own portfolio only did that. And you would probably even have had quite a few of the winners. That's how concentrated the market's become. So the questions we would be asking is, what price am I paying? And in South Africa, I would particularly be looking at dividend yields. What is already discounted? What bad environment or what poor economic growth is already discounted in these prices? And then to recognize that big trends can carry on for quite some time. So we recognize that you have to have representation in your portfolio, but you also have to build in an alternative view, because the slide I showed you on cycles also showed you how they build up, the speculation that often fuels them. Almost in every case, there was a very large element of speculation towards the end of that cycle, and shifts can happen very quickly. So the next chart I want to show you, there are a lot of lines here, so let's start from the bottom. In November, we started getting clarity on a vaccine, and Biden won. So we had clarity on the US election, and we had a little bit more clarity on the vaccine. We didn't know exactly when it was going to be rolled out, who was going to have it, but we had a little bit more clarity. What happened immediately was the lowest return here, actually the US tech stocks, pretty much flat. Now we're talking here about a period of 2, not even 3 months, a very short space of time. But look what happened to the top green line, which is the Russell 2000, small and mid-cap stocks in the US. They went up by 30%. Our global fund, which had lagged really badly over the last few years, showed one of the strongest recovery participating in that part of the market. So you can see what happened is small cap started outperforming, tech started underperforming, and value started outperforming. Now, we don't know if this is a permanent shift. We don't know if it's going to go up in a straight line, whether they're going to be stops and start. But this is significant, a very significant turnaround that took place in the space of a few months. So if we actually look at value versus growth now on the global index, it's actually outperformed, value's actually outperformed growth for the best part of a year now. So what do we bring to the table? If we look at, this is just a Morningstar chart, and we look at the different ways that Morningstar objectively classifies managers, you will see that quite a lot of managers are core and large. So they're in the middle, in the top 2 blocks of the center 9, where all the managers are. We are the only manager, together with, I think, Prudential, that are slightly to the left, what they call core value, so by no means deep value, and more on the mid side, and also not small. So I think what this shows you is this combination of managers actually gives you a very good spread between size and style. So one of the things we bring to the market, to the table, is the fact that our style is different from the other managers. So we're a good complement in terms of giving you access to the different elements you need in order to navigate big cycles. And none of these managers, it's very hard for them to get each cycle perfectly right every time. It's very hard. They're all going to be wrong for some period of time and get caught by a cycle that they're not in that lasts a little bit longer than they thought, or another one that starts a bit earlier than they thought. So in terms of South African assets, what's fascinating to us is, if you look on the left-hand side, how local pension funds are at the lowest domestic equity exposure since 1980. And this to us is just another element to build into how badly people are perceiving these assets. If you then marry that with valuation and marry that with possibly an environment that could be slightly better than people have been expecting, you could actually see some really exciting prospects for some of those companies. And you can see how international has gone up, the red line. All the international allocation is now at the highest it's been. And you can see that Bonds are also creeping up as the rates gone up. Cash is pretty much there or thereabouts. But you can also see how strong the selling of our assets has already been. And right at the beginning of the presentation, when I spoke about the chasing the assets that have gone up, this is the other side of that. So as our sentiment has become poorer and as our asset prices have lagged, they have also been sold on by international and local investors. So to us, this is a positive. This is the opposite of the crowding that's taking place in the FANG stocks, the index funds, and the large stocks internationally. We found this quite interesting. If we look at our portfolio, during March and April last year, our team spent quite a lot of time thinking about the things that we had got wrong the year or two before and working very hard at making our portfolios more robust, making it possible for them to work over many more scenarios than we had in the past, and also providing more diversification. So for instance, the drawdown in March gave us the opportunity to increase our resource exposure because those stocks just were hammered during that month. So you'll see that at the moment, if you look at the balance fund, the SA Inc., and some of those SA Inc. companies, by the way, have actually got offshore operations, but no one's recognizing that at the moment. They're just dealing with them as if they're only reliant on the South African economy, is less than a third. The rand hedges are 20, offshore equities about a quarter, and then we've got a great spread, including some inflation-linked bonds, which we think are offering great value at the moment in our bond portfolio. Some NCDs and a proportion in cash, which of course, as you know, the rates have really collapsed and it's difficult to find value there. If we then look further and say, what do we also bring to the table? If you look at these well-known managers and you look at the representation of their top 10, you'll see that they've pretty much got very similar stocks. There are at least 5 or so that are held by most of them. Our stocks are in bold, and we've bolded them across the other managers as well. And you can see that they're not that widely held by others. So we're a really good addition for going deeper into the market down the cap spectrum, because we've had a very narrow market. If the market broadens, it means that more stocks will participate in investor interest, and that means that the lower cap stocks will get some attention. Those also happen to be mostly a lot of them very economic sensitive stocks. So what we're hearing in the narrative out there at the moment is a lot of market players are becoming more interested and more positive on the valuation side of SA equities. But a lot of them can't invest as broadly as we can because they are much bigger than we are. And we think that's another advantage that we bring to the table. If we look at our balance fund as an example, we've had a very poor last 2 years, we recognize that. And we've spoken about that at length in our communication and to you in presentations. But if you look over time, you look back almost 20 years, the fund generally does better than the average in the category, and we are busy catching up fast. So we are almost back to, on a 5-year basis, we're back to average, which we're very pleased about. And also the returns have turned positive. This is not a fund that you want to see negative returns for a long period of time, even though having a large component in equities does bring the risk of a little bit more volatility. So our strategy at the moment is domestic shares, including small and mid caps, selected global shares. As I mentioned before, the market isn't just one area that looks exactly the same. There are different sectors that are behaving very differently. Selected resources companies. We've got government bonds. We've also added inflation bonds, because if inflation starts lifting globally and internationally, we think those are going to be a fantastic addition to the portfolio. We are more concerned about credit. We don't think that the risk return, the benefit is there in terms of the spreads. And one of the reasons those spreads are not so attractive to us is if you look at what clients have done, and you would have seen all of this in your clients, is they've moved a lot of money out of growth assets into offshore and into local income funds. And that's caused a lot of demand for those kind of instruments. And we just think that is not that well priced anymore. We're talking particularly about credit now. Global bonds we would be concerned about because the rates are very low. I've shown you the chart earlier on. Expensive momentum-driven shares we think are not an area we would be interested in. And then cash. We have some cash in the portfolios, but we wouldn't have very large holding in cash. So to sum up, extreme markets call for an open-minded attitude and a recognition that some parts of your portfolio sometimes may not work for a while, but it's going to prove to be valuable in the long run. Many investors have capitulated. They've sold unpopular areas and they've moved into what they see as safe areas. And I've shown you how we think there's 3 layers of risks that are building up around some of the safe assets that people have put their money in the past. So what are we doing? We're taking a longer term view. We're looking beyond the pandemic. We're focusing on out of favor areas only because there's this huge bifurcation and those areas to us are very attractively priced at the moment. We're using these extreme conditions to buy some great businesses at fantastic prices. And we're constantly reviewing our portfolio and making sure that it's diversified. And finally, we are constantly learning from the lessons from the past. What could we have done better? Can we build that into our process to make sure that we don't make some of those mistakes again? Finally, market volatility has actually amplified the opportunity to invest in attractive valuations across many asset classes. Our portfolios are full of these opportunities, and we think that the best way you can navigate cycles is to construct a portfolio that will weather a large range of future outcomes and stay invested in that well-constructed strategy. Thank you very much for listening.